In this presentation, we will work a problem related to the purchases method for recording supplies inventory in a modified accrual system in a fund accounting system for, in this case, the general fund. Note that there are two methods that we can use for the modified accrual for fund accounting, that being the purchases method here and the consumption method. The two methods will have different income statement amounts. However, the post-closing trial balance will remain the same. Both methods are going to be different than standard accrual accounting, or at least have added components to it. We will compare and contrast to standard accrual accounting as we take a look at this process within government-wide accounts as well. Government-wide activity being on a normal accrual basis, so we'll be able to compare and contrast something like the fund accounting on modified accrual to an accrual basis, which will be used in the government-wide activity. This is going to be our information. We have the information on the top left. We're going to post that and use this trial balance so we have something that is in balance and we can post to it and see the result being in balance. We're going to have a simplified trial balance with not too much going on so we can concentrate in on the recording of the supplies. We've got the assets in green, the liabilities in orange. We have what would be the equity, which we're going to say is the fund balance, the net assets minus liabilities section, and then what would be the income statement accounts, the dark blue accounts if we were talking about a for-profit accounting. Here, same thing, although it would have the waters being muddied with regards to fund accounting, because in a modified accrual system, we might be posting the budget and have accounts such as estimated revenues, possibly appropriations, and then the encumbrances accounts. We're not going to be posting to the estimated revenues and the appropriations. We will be using the encumbrances and the expenditures, but just note that those items could be around and confuse the picture. In some cases, we're going to be having a simplified problem here so we can concentrate exactly on what we want to concentrate on. Note that the debits have positive numbers or an unbracketed, credits having bracketed numbers. And obviously, when we consider our trial balance, we can just see, and when there's not a whole lot of accounts, you can just basically see that the assets here minus the liabilities equals what would be the equity or the fund balance type of accounts. Part of what we're going to be needing to do within these two methods is apply out between the fund balances in terms of the unassigned and the non-spendable items. First item, we're going to say that supplies ordered at an estimated cost. This will be the estimated cost. This is going to be similar to us basically giving an invoice out, or a purchase order, not an invoice, a purchase order that we were going to give to a supplier in a normal accrual type of accounting, at which point we're requesting inventory, but we haven't yet paid for the inventory, we haven't yet received the inventory, and therefore we don't typically post the purchase order to the general ledger. Here we will. That's when we're going to use this kind of strange holding account, the encumbrances account, that we're going to basically be transparent, show that until the point in time that we actually trigger the purchase, where we can record this in with expenditures or with the inventory, depending on the method that we are using. So here, we're going to debit the encumbrances for the estimated amount. We're going to credit the encumbrances outstanding. So encumbrances going up, encumbrances outstanding going up. These will always be equal and opposite. We're going to have to reverse it when we actually receive the supplies. Next, we're going to say that happens. We receive the supplies, and therefore, there's two things that need to happen at this point in time. We need to reverse the encumbrances, because this is just a holding account until we can actually record the expenditure or the inventory, which is happening at this point in time. We're going to reverse the encumbrance exactly for what was in there, the estimated amount, not the actual amount. The actual amount may differ. So we're going to record the reversal, encumbrances outstanding, then going down. It has a credit balance in it, so we're going to debit it. And the encumbrances having a debit balance, so we're going to credit it, bringing them back down to zero. Now we're going to record the transaction in a method closer to what we would think on, in essence, a cash basis method, recording the expense or expenditure, the expense related account, and crediting cash. So note, this would kind of be a cash basis as opposed to an accrual type basis, at which point we would record the inventory supplies as an asset, count it at the end of the time period, then record the expense for the item that was consumed rather than the item purchased. Hence the name purchases method here, because what we're doing is recording the expenditure, as you can see, for the full purchase price, the cost in this case, and that's going to be the cost in every case. In this case, we of course paid cash for it. and therefore we're on a cash basis. We recorded the full amount on a cash basis. Under an accrual basis, we would only be recording the amount that we consumed by doing an adjusting entry at the end of the time period. So we have the expenditures increasing, the other side go to cash decreasing, and normally that would be it. You would think, okay, that's all you do on a cash basis. But on the fund accounting, we have to do something else to it, and that is that what we really want to do is be able to say, hey, look, these fund balance accounts, part of them are already assigned out, because remember what the fund balances are. It's going to be the net assets minus liabilities. And so they represent what people are going to want to assign out. They're going to want to appropriate. They're going to want to use that money in the future. So what we want to do is classify as unassigned versus non-spendable. We want to say, hey, look, this amount represents inventory that we've already purchased. You can't spend it because it's already been basically spent. It represents an asset on the books in the form of inventory. So although we're on a cash basis here, and we've recorded on a cash basis as often is the case in this kind of modified accrual basis, we also want to record a kind of an accrual component on the balance sheet, both recording the asset, but we're probably more concerned actually with breaking out the fund balance, because that's what people are going to look at and want to spend, right? They're going to say, that's the net assets. That's what I want to, that's what I want a piece of in the future. So we're going to say that to do that, we're going to have to do the physical count still. We'll do the physical count, 77,100. We'll put that on the books. We'll say debit supplies. That's what's still left over. So we're going to adjust the supplies to the physical count, which is kind of what you would do in an adjusting entry. But then the other side is not going to go what you would expect, expenses on an accrual accounting, because you would expect this amount to go down from the amount we consumed. I mean, the amount we purchased to the amount we actually consumed. We're not going to do that. We're going to keep this on a cash basis. We're going to put the other side directly to the fund balance for the non-spendable, because that's really the main point. We want to record the expense on a cash basis, and then we want to basically assign out the amount here on the amount that's going to be not assignable. So this is the difference between the purchases method and the consumption method. The income statement will be different. The non-spendable amount will be the same, but once we do the closing entries, then we'll be in the same post-closing trial balance after we close out the temporary accounts to the fund balance type of accounts. So if we record this, then we're going to say that the inventory is going to go up to the physical count. That, of course, matches the physical count. We're going to say that the fund balance then is going to go up to the 77,100. And now we can say, hey, look, assets minus liabilities equals the equity, but you can't spend this. This amount is applied to or represents spending that already happened that's on the balance sheet in the form of inventory of supplies. Then if we close everything out, which we only have one account here, the expenditures, we're going to close that out to the equity section to get to the post-closing trial balance. We would be closing out revenue and expenditures, but this simple problem, all we have is the expenditures, so we can focus in on it. So expenditures as a debit balance, we're going to credit it to make it go down. Then the other side goes to the fund balance unassigned. So here's the expenditures. We're going to credit it, making it go to zero. We're going to put the difference into the fund balance unassigned, making it go down. So now we have the assets minus the liabilities equals what would be the equity or the fund balance net assets. But we're saying, hey, there's a breakout between the two. These are the ones that are unassigned. So if you're going to start to bid and appropriate and claim part of it, that's where you want to go. You can't take this amount because it's already been spent. It represents assets on the books up here that are the 77,100. So that's really what we want to do. Now we want to look at year two. Let's see what happens in year two. If we roll this forward, this is the post-closing trial balance. That's our ending point, which will be our beginning point for the next year. So here we are at the beginning point. Similar type of series of transactions that we're going to go through, just focusing in on these items for inventory. We're going to say we sent the purchase order out. Once again, we haven't received anything. We haven't paid for anything. We wouldn't normally record it, but we want to record it to this holding account called encumbrances. So that's the first thing we'll do. Debit encumbrances for that estimated amount. And then the other side's going to go to this encumbrances outstanding. Then at some point in time, we'll actually receive the inventory, triggering what would normally be the point in time that we record the expense at the point in time we receive the inventory. So now under more of a cash basis type of method, we're going to, instead of debiting inventory supplies, which would be more of an accrual basis, we're going to record the expenditures. But first, we'll reverse the encumbrances outstanding. So we're going to have to take these off the books because now we can record the actual expenditures that actually happened given the fact we've received them. Therefore, we're going to do the exact reversal of the prior transaction, reversing this back out to 0, encumbrances going back down to 0. Then we can record the transaction of expenditures being the debit and the cash being the credit. So we're basically recording the expenditures, similar type of account on a cash basis. So we're going to say the expenses on a cash basis here, as we saw last time. We're recording the expenses on more of a cash basis with this modified accrual accounting, general fund accounting. The other side decreasing cash. Note, cash is going negative in this example problem because all we've been doing is recording expenditures. So don't let that throw you off that, now we're like overdrawn in the cash. So that's going to be that item. And then we'll do kind of the unusual thing here, and that is note that this inventory item is just kind of hanging out there since last time because we're basically recording this inventory on a cash basis, and we're not really touching the asset account because we're just recording the expense when we buy it. What we're going to do then is adjust this on kind of like an adjusting entry process. But remember, our main goal is really to kind of assign out the fund balance. These two need to match. So what we're going to do is say, all right, let's adjust this. We're going to say this is 77,100. It needs to be equivalent to the physical count we had at the end of the year, 60,000. So we need to adjust it down by 17,100 here. So that's all we're going to do. We're going to say this needs to go down. It's a debit. We're going to credit it by 17,100. The difference is going to go into the fund balance. It's a credit, and we're going to debit it, making it go down. So we're going to, those then, the supplies inventory decreases to 60,000, matching the physical count, and then the fund balance non-spendable is equal and opposite to it. And again, this would represent the fact that the assets minus the liabilities, part of it's going to be assigned to what has already been spent in the inventory supplies. Again, assets are negative because we've got the negative cash here, so don't let that throw you off. And then we have the adjusting entry, which will basically adjust out, or the closing entry, closing out the expenditures, which is the only thing we've got on the books at this point. We haven't been recording revenue or any other type of activity. Closing it out, it's a temporary account. It's got a debit balance. We're going to do the opposite thing to it, credit it. So we're going to credit the expenditure and debit the fund balance unassigned. So that brings this amount down to 0, fund balance unassigned. Then it's going to flip it to basically a debit because once again we're overdrawn on the cash. But the bottom line is that the inventory here for the inventory of supplies is matching up to the fund balance that is non-spendable.